A $38,000 car, financed over 6 years at 7%, costs $46,600 by the time the last payment clears. But here's the part no one mentions at the dealership. By year 5, that car is worth $15,200. The owner still owes $7,500. The gap between what they owe and what they own has been negative for most of the loan. And this isn't a worst-case scenario. This is the average. The buyer didn't make a reckless decision. They walked into a dealership, got approved, signed papers that felt like progress, and drove away in something that smelled like a fresh start. The math was presented clearly. The monthly number fit the budget. The process felt responsible. But something about this product works differently from how it appears. Not because it's defective, not because the terms are hidden, but because the entire structure was built around a single insight: that people don't calculate cost, they calculate comfort. And comfort, in this case, is the most expensive thing on the lot. 85% of new car buyers in the United States finance their purchase. The average loan now stretches nearly 6 years. The average monthly payment sits at $749. And nearly 1 in 3 people who trade in their car owe more on it than it's worth. This isn't a fringe behavior, it's the default. There's a moment in every expensive purchase where the stomach tightens, a number that forces a pause. That pause is a signal, the brain's way of saying, this costs more than it should. Financing doesn't remove the cost, it removes the pause. That's what makes car loans psychologically different from other debt. A mortgage builds equity in something that historically appreciates. Student loans attach to earning potential. A car loan attaches to a machine that begins losing value the moment it leaves the lot. And the product is specifically structured so the borrower doesn't feel that loss happening. The mechanism is a cognitive pattern called payment decoupling. When a purchase is broken into small, regular installments, the brain stops associating the payment with the object. The $749 leaving a bank account each month stops feeling like car money. It starts feeling like a utility, a fixed cost of living, like electricity or rent. And once a payment feels like a utility, it becomes invisible. No one reevaluates their electricity bill every month. No one reconsiders whether they should keep paying. This is the psychological architecture that makes car financing so effective and so quietly expensive. It turns a $46,600 commitment into something that feels like $749. It converts a 6-year financial exposure into a monthly inconvenience. And it relies on a specific illusion that if the payment fits the budget, the decision must be sound. But the budget only measures cash flow. It doesn't measure wealth. It doesn't measure what that $749 could have become over 6 years if it had been directed somewhere else. It doesn't measure the slow erosion of value happening underneath the hood while the payments hold steady. The car loses 20% of its value in year 1. The loan balance barely moves. For the first 3 years of most car loans, the borrower is underwater, owing more than the asset is worth, and most of them have no idea. It's like standing in a river that's rising an inch per hour. The water is warm, the current is gentle, and because the change is so gradual, there's no single moment that triggers alarm. No one runs, no one even looks down. The water just keeps rising, and the footing keeps shifting. And by the time the discomfort becomes undeniable, the options have already narrowed. The auto lending industry is not a service that helps people afford cars. It is a $295 billion global market designed to extract maximum revenue from the gap between what a car costs and what a buyer feels. That distinction matters because every structural feature of the modern car loan, the ones that feel like flexibility, like accommodation, like help, exists to widen that gap. Start with the term extension. In 2025, the average new car loan stretches 68 months. Over 1 in 5 new auto loans now run 84 months, 7 full years. Lenders don't offer longer terms because buyers need more time. They offer them because longer terms keep monthly payments low enough to prevent the pause. The pause where the buyer reconsiders. The pause where the buyer walks away. Then there's the rollover. Nearly 30% of trade-ins carry negative equity. The buyer owes more than the car is worth. Instead of resolving that debt, dealers fold it into the next loan. The average buyer with negative equity finances $11,400 more than a buyer without it, and their monthly payment hits a record $916. They're not buying one car, they're paying for one and a half. This is friction design in reverse. Every point of resistance that might slow down a purchase, the sticker price, the total interest, the depreciation curve, the equity position, has been systematically smoothed away. The buyer never confronts the full cost in a single moment. It arrives in fragments, spread across years, buried inside monthly statements that feel routine. The system doesn't fail the buyer. It performs exactly as intended. Every extended term, every rolled over balance, every softened monthly number is a feature, not a flaw. The product was designed so that the moment it works perfectly for the lender is the same moment it costs the most for the borrower. Here's where the math becomes personal. Take two people, same income, same age, same city. One finances a $38,000 car over 72 months at 7%. The other buys a 3-year-old car for $15,000 in cash and invests $648 a month, the exact amount of the first person's car payment, into a broad market index fund. After 6 years, person A has paid $46,600 for a car, now worth roughly $12,500. Total cost of ownership, after subtracting residual value, $34,100. Person A owns a depreciating object, and nothing else. Person B has a 9-year-old car worth about $6,000 and a portfolio worth over $64,000. The difference in net position between the two is $57,500, not over a lifetime, over a single car cycle. Now extend that pattern. The average American buys a car roughly every 6 years. If person A finances 3 consecutive vehicles at similar terms, which is statistically normal, they will spend over $25,900 in interest alone across 18 years. That's money that purchases nothing. It doesn't reduce the principal faster, it doesn't add value. It evaporates. If person B maintains the same discipline across those 18 years, buying used, investing the difference, the compounding effect transforms the gap into something difficult to look at. The investment portfolio doesn't just grow by the amount contributed, it grows on top of its own growth. After 18 years, the wealth divergence between these two people isn't a rounding error. It's a down payment on a house. That $749 average monthly car payment, redirected into an index fund for 20 years at historical market returns, becomes over $570,000. That's not a projection designed to make financing sound catastrophic. That's just what happens when $749 a month compounds instead of depreciates. If the monthly payment was the first number discussed at the dealership, not the total price, not the interest rate, not the cost over the life of the loan, then the product is already working. The conversation was structured to keep attention on the one number that feels manageable and away from every number that doesn't. The car loan isn't a mistake people make, it's an outcome people arrive at, guided by a system that was built to make the most expensive option feel like the most reasonable one. The friction was the warning. The pause was the protection, and the product's entire purpose was to make sure neither one survived long enough to change the decision. The buyer who drove off the lot didn't fail. The math was presented in the only format that would keep them moving forward. Small enough to feel safe, spread thin enough to disappear. Like standing in that rising river. The water was warm, the current was gentle, and the debt kept climbing at an inch per hour. Some losses aren't mistakes, they're outcomes. Designed, packaged, and sold at 7%. This is Costly Choices.